I'm Hannah Wise. You're watching CNN Money Switzerland. Welcome along. Stock markets rallied yesterday. US markets saw an historic bounce, in fact, on Monday, which continues today now that the Federal Reserve has cut interest rates by 0.5%. It's a sure sign of the level of concern as the coronavirus continues to spread around the world. So will Europe and the SNB follow? Well, earlier today, ECB President Christine Lagarde called for joint action with central banks to help ease pressures on the global economy. And the G7 countries also announced they could use policy tools to curb an economic slowdown if necessary. But today revealed no specific actions to do so. In this episode, we have two economy powerhouses to talk us through it all. Cedric Thiel from the Graduate Institute joins us from Geneva. And here in Zurich, we have EFG Chief Economist and former Central Bank of Ireland Deputy Governor Stefan Gerlach. Welcome to you both. Cedric, let me start with you in Geneva, actually. This is a surprise move by the Fed. What does it mean?
So I think it means that the Fed is quite concerned that the coronavirus could really weigh on growth and take some insurance policy by really easing conditions to make sure that financial markets don't seize up. If it turns out that they were too overreactive, they can always backtrack later on. So I see this big move as erring on the safe side, if anything.
So erring on the safe side, Stefan, but this came out of the blue. We were talking about policy moves if necessary, and now they appear to be necessary.
Yeah, it came quite surprising. I mean, market participants had priced in a 50 basis point cut at the meeting on March 18th, but it's not March 18th now, so it came much earlier than anticipated. And plainly, the Fed is concerned.
It's clear that the global economy is very exposed. There's a lot of talk about central banks coming together now to tackle this. So where does this move by the Fed leave the ECB and, very importantly, the SNB, which is already in a pretty sticky position?
It would put more pressure on the ECB to do something. But I think the ECB is not really in that sort of space where they are likely to do something very quickly.
Even though we heard Christine Lagarde saying she would like joint action.
She needs to persuade the Governing Council that joint action is necessary now. And I suspect that there are several members of the Governing Council who don't think that this is something that needs to get done right now. And of course, the Fed doing something tilts the balance a little bit in the direction of doing something. Will
this, Cedric, have blindsided the ECB? Because they are already in a pretty sticky position, as I put it. You know, they've used all their economic stimulus measures. You know, there is a lot of consideration has to go into whatever they do next. Have they been blindsided by the Fed?
I don't know if I would say they've been blindsided. Usually central banks communicate and inform each other. Doesn't mean they take that decision necessarily jointly. This said, the Fed was in a much more comfortable position. Starting from a positive level of interest rate, they have room to cut. European central banks are in a much more tricky position. And they could push rate down, but there's several questions whether once you go at very negative values, if the effectiveness is similar. It's still an open issue. But it's definitely making their life more complex. Yeah.
Is an interest rate cut, Cedric, useful in this situation to fight the spread of coronavirus?
That's an interesting question. So what central banks can do, and monetary policy more generally, is to act on the demand. So if you have a situation where you have a lack of aggregate demand, that was the case, for instance, in 2008, 2009, then monetary policy is quite a good tool, as is fiscal policy. If, however, you have a shock coming from the supply side of the economy, an oil shock, for instance, this is much trickier. And to a large extent, the coronavirus shock is a supply shock. We have disruption into global supply chain. We have restriction of people being able to show up for work in places like China, but not only. And if this supply side shock dominates, then central banks cannot do so much in the end.
You mentioned demand, and I know you don't mean demand in this respect, Cedric. Let me turn to you, Stefan. This plays right into what President Donald Trump has been asking of the Fed to cut rates.
Yes, of course it does. And perhaps that might have played a small part in this decision. I suspect not. But it looked like the Fed was going to cut rates in 2 weeks' time. And why wait 2 weeks? Why not do it right now? But of course, you're right. It will have pleased President Trump no end, I'm sure.
OK, so the ECB may make a move following the Fed's lead. Yeah. Where does it leave the SNB? Because they already have the lowest interest rates in the world. They have a very strong franc, an export economy, which is already on a knife edge.
Yes, I think that's quite right. My suspicion was that the SMB was a little bit more likely than the ECB to cut interest rates. But of course, this has all been changed by the Fed decision. I don't know what has happened to the Swiss franc here in the last 20 minutes or so. But I mean, we have to wait and see. They have a decision coming up very soon, and there is the possibility that they may do something. It depends on how this sort of plays itself out right now. The Swiss economy is, I think, quite strong. And isn't sort of indirectly in need of more stimulus. But I mean, we have to see how this sort of plays itself out.
What do you think, Cedric? Is the SNB under more pressure than other central banks because of its unique position?
So reduction of interest rate in other countries will mechanically narrow the gap of these countries' interest rate vis-à-vis the Switzerland interest rate, which is put a pressure on the exchange rate. Whether that pressure will build up to such an extent that the SNB has to react, that I don't know, and I guess we'll find out pretty soon. But it definitely makes them in a more complex situation.
I mean, is there the likelihood that they would sit out a first round of action by central banks?
That I don't know. I have no particular insight in the behavior of the SNB. I guess the directorium will communicate in due time if they decide to take actions.
Stefan, what do you think?
My suspicion is that if there is coordinated action, the SMB will play along, even though they may prefer not to do anything right now. It is really key for such an open economy as the Swiss economy to be fully engaged in the international monetary policy developments and so on. So I suspect if there is coordinated cuts, the SMB will participate.
Well, this is very interesting timing. Cedric, if I can turn back to you, the SNB announced just yesterday or signed the deal that it will pour an extra $2 billion into the federal government and Swiss cantons from its profits. How impactful do you think this kind of move will be given the situation?
So ultimately, what the SNB does is transfer part of its profit to the cantons and the state. The key question is what the Confederation and the cantons do with this money. If they repay the debt, which is already going down, that wouldn't matter much. If they decide to use these billions for additional spending or tax cut, then there would be more of an effect. So I think the question here is really more on the Confederation and the cantons.
OK, well, we'll have to wait and see, I guess, how that transpires. But Stefan, on that topic, I mean, you predicted here on the programme that, you know, that the SNB would never use its reserves for monetary purposes. Are you starting to think that you might change your mind on this idea?
So I think it's very unlikely that the SNB would experience pressure on the Swiss franc and therefore have to start selling off foreign exchange reserve to support the currency. So I think this is very unlikely. It's possible that a part of these massive foreign exchange reserves may be used for monetary policy purposes, but it seems rather unlikely.
Well, certainly the challenge for the central banks now is to kind of predict what is going to happen next with this crisis, which is an incredibly difficult thing to do. But Cedric, I mean, profits can quickly turn to losses in a crisis like coronavirus. How do you see this developing?
Well, that's very hard to say. So we don't know yet how broad the coronavirus will be. Will it be like SARS, which after all was relatively short-lived? Will it something that lasts much longer? It's extremely hard to say, and all the statistical office, IMF, and others are working hard on adjusting their forecast. But at this point, without more data, it's a pretty tough call. An optimistic data point is that China is now reporting that the wave of infection is starting to go down. So that would point that the viral effect would last like a month and not more. can only hope that this is also the case more broadly, so we quickly go back to normal after some disruptive time. But it's really early to say that with any degree of confidence.
So in the meantime, Cedric, which parts of the economy here in Europe are particularly exposed to the spread of the virus?
So I think any part that has to do with international activity, tourism is the first one, and this reduction of travel, especially from China, which is a big source of tourist arrivals in Europe. Then all the economies that rely on exports. So one thing that is quite striking, the virus in China is, for instance, flights were halted, and flights are not just passengers, it's also cargo. So we have a big disruption in the chain transferring goods all over the world. And now that companies are really operating with just-in-time inventories, it doesn't take much of a disruption to create serious problem. So companies that are relying heavily on global value chain are more vulnerable, either because they cannot bring their goods to their customer or they cannot bring the spare parts to the factories to keep them running.
What are your big concern points, Stefan, when it comes to the economy and how exposed we are in Europe?
So I think right now we're likely to see a slowdown in as Cedric mentioned, in transportation industry, in restaurants and hotels and so on and so forth. My concern is that over time there must be a number of small companies that are experiencing cash flow problems. And they can handle sort of lower cash flow for a while, but at some stage they have to make interest payments to banks, they have to make tax payments, they have to pay for their utility bills and so on and so forth. And at some stage, if this continues, I think small companies across Europe may come increasingly under strain, and that's my concern. When will that happen?
Well, the ECB are considering using bank loans to combat the virus impact.
For a good reason, yes, because I think they are also concerned about this. And I think this is probably a way in which central banks can really do something if they can sort of make sure that small firms have access to liquidity at low interest rates and so on. I think that may become necessary.
And with what's happened with the Federal Reserve going ahead, making this cut this Tuesday, are we now at more risk of recession?
It depends on how long this thing will last. I mean, I was in Hong Kong during SARS, and what we saw there was the second quarter of 2003 was negative. It was negative in Singapore, it was negative in Taiwan. In China, the growth rate fell a lot. But the third quarter was very strong in all in all four areas. So it depends very much on how long this is continuing. If this continues for a while, of course, the risk of a recession when it grows by the day.
And may I put it to you, Cedric, I mean, what is this risk of recession from your perspective?
So I think it's very substantial. The very interesting aspect is whether we're going to have a V-shaped recession. So let's say that the epidemic gets very serious in this quarter, but then we get out of it. We would have growth reading for the first quarter would be very low, but then GDP in the second quarter would go back to where it would have been anyway. And then the economy would keep going on a pre-epidemic growth path. They would still mean, by the way, that 2020 on average would have a low GDP simply because the first quarter would be low, but the rest of the year would be quite normal. If, on the other hand, the virus turns to be much more persistent and harder to cure and require a persistent measure of isolation or limit mobility, then we go into another story. And as Stefan rightly said, this is going to put pressure on firms' financing margins. And especially small firms. The big firms have some reserve they can use, but the small firms don't really have it. There could be a role for fiscal policy maybe to help them through this adverse time.
Well, this second scenario that you're painting here, this kind of doom and gloom scenario that you're painting, I mean, is this perhaps what the Fed are concerned about by cutting rates today?
You have to be aware that the US economy is much more sensitive to the state of financial markets than just about any other economy. And that is
much more so than Europe.
Much more than so than Europe. In Europe, banks matter. In the US, the financial markets matter because most people in the US, or a very large number of people in the US, they have bought their own house. They have their pensions in financial markets and so on. Here in Europe, we have state pensions. As the prices go up and down, it doesn't really affect us. Many people in Europe, particularly in Germany and Switzerland, they rent. They aren't really impacted by changes in interest rates and so on. But the US economy is very, very sensitive to the state of play in financial markets. And I think cutting interest rates now in the US made good sense, made much more sense to do so there than in Europe. I think Madame Lagarde will have much harder work, I think, to persuade the governing council this is the time to do it.
I'm probably very surprised at finding herself in this situation so early in her tenure.
I'm sure I'm sure she's very surprised. I mean, in many ways, President Draghi pushed through a very controversial expansionary program last September. And I think most people thought, I certainly thought, that there would be no need to do anything in the euro area for another year or 18 months, and perhaps the next change would be in the direction of tightening monetary policy. But here she finds herself in the situation where she might well have to try to persuade the governing council to go for a cut and to support the Fed action.
All right, we'll leave it there. Cedric Thiel in Geneva, thank you very much indeed for joining us. And Stefan Gerlach here in the studio, my thanks to you as well.
Thank you.
OK, well, if you have been affected by any of the stories you've heard today, if you're a small business, perhaps you'd like to get in touch with us and tell us your story. We're available on social media, LinkedIn, Twitter, Facebook and Instagram. And of course, everything that we have for you is available on our website. Just head to cnnmoney.ch and we'll be back with another episode tomorrow. Bye-bye.